Okay guys, I have a super important video for you guys today. If you actually take SoFi as a serious investment, whether that's for yourself, whether you already own a position or are about to get into one, you have to see this video. I have broken down the true cost of what it takes to actually lend out our products to other people, which whenever it comes to the lending side of our business, that makes up about 70% of our overall revenue. So understanding it is absolutely crucial. But without further ado, let's actually go in and look at this Excel spreadsheet that I've created for you guys on SoFi Technologies. Now, if you've been around the channel, you've seen this before. I have a big breakdown of all the different products and services that SoFi has and all the numbers through every quarter that they've been public, okay? Then I have all the finances, and I mean, not just the basic finances, but also really niche things to try to help us get a better look at SoFi Technologies. But then even before we get into the cost of loans, and that's what we're going to be covering, the newest segment of this, spreadsheet that I've been making, I need to touch up on the actual potential interest. Potential interest is a very important formula here that I've created that's not public information, okay? So what this actually does is it takes two different segments that we make on actually how we earn money through our lending division. So that's through sale of loans and then the actual interest income that we actually create. So these two, right? But the only problem with this is that it doesn't actually show how much money we could make if we didn't actually sell the loans. If we didn't sell the loans, this would show a broader health to actually how well we're doing with these loans overall. This way, with potential interest, we can see how well we're doing with the actual loans and then actually compare it to, how much our FICO scores are going up or down, or compare it to how much the costs are defaulting or anything like this, so then we can get a straight one number that shows us how well the quarter did for our loaning business. Now, these numbers are great and all, and I've actually just charted it so then you guys can see it here. So this would be the student loans. It's been slowly dying off, but that's of course to be known over the last 2 years because we haven't had any new student loan business. So of course it's going to be dying. But whenever we actually look at the personal loan side of things, we see a completely different picture. Look how well that these actual charts have been doing. The only problem with this, however, is it doesn't show the actual net benefit of these potential interests. This is only a gross number. Now, the difference there is that this doesn't show off how much we're actually costing to fund the loans, right? Or even the potential side that, some people might not even pay us back. They might default on the actual amount of payments that they have to us. And that is why it's so important that we understand the cost of loans. Now, I really want to talk to you guys about this because this was a very hard part to actually source out all of this data. Now, I put in a lot of hours for this for you guys, so make sure you guys hit that like and subscribe down below if you want to see more financial content just like this. But with that out of the way, let's jump in and look at the total cost of loans for SoFi Technologies, okay? Because this is super important. So what you'll see up in the top corner here, we're just going to jump into the very basic things. This is the total potential interest is up in this top corner, okay? So this is very important. It's been growing like crazy. That's super great. That's all of the student loans, home loans, and personal loans all added up together. Not too complicated. Now, this next line here, this is warehouse facilities, okay? So warehouse facilities is like a line of credit for, big businesses to actually loan against. And then this is actually how we were funding our loans for the longest time. And then you can go ahead and compare that with the actual warehouse interest to see how much we're actually paying on that amount of money, right? $2 billion is, an insane amount of money, but we only really have to pay 2.7% interest on that amount, right? So what we can see here is that, it was really high in Q2 of 2020 and then started to drop all the way down to 1.4%, which is great because these loans are actually, variable in nature. They can change all the time. But now we're starting to see the opposite effect. Like lately in the last quarters, it's been starting to go up, and that's just because of the macro environment that we're actually in. But then this is where the next line comes into play. And this is our interest paying deposits, okay? So this is all of the direct deposits and everything that we have to pay a certain interest rate on. Now, this hasn't taken effect all the way until Q1 and Q2 of 2022, okay? This is when we actually became a chartered bank and we could start taking on a bunch of deposits. And you can see that we actually have to pay a certain interest rate. However, the interest rate is actually quite low, much lower than warehouse facilities at 0.39% and then 0.99% at the end of Q2. So then really we need to start talking about adding up these four categories or two categories plus their interest, right? So with warehouse facilities and deposits, we want to be more, deposit heavy than warehouse facility heavy. And so we'll start to pay that down. You can definitely see the difference between Q1 to Q2. We almost paid down over $600 million. Well, a little bit less than that, but, about 5.5 million, but still absolutely amazing because the interest rate difference between warehouse facilities and, direct deposit or deposit interest rates are about 1% total. So it's a huge difference. But then all of that actually gets us to the warehouse and deposit expenses where we can get a single number number that actually shows us all that information, okay? So that's what this beautiful line is going to do, which it's actually been climbing up the highest we've ever seen in Q2, but that's also because we have a lot of deposits right now. So hopefully, we can actually start to switch over the warehouse facilities onto deposits and continue growing that. And then, also the people who are direct deposit users, who are, the people accepting those deposits, are also higher income people for us because, they also get into things like spending with their debit cards and everything like this that just adds on to that total. But then going on from this, we can see all three of the different segments. Now, there's a couple things that I've added in here that are super important. So one, annual default rates, okay? As you can see, student loans across the board, 0.4%. Home loans across the board, 0.1%. Very, very low. Personal loans, because, we're at one point we were paying, or we're charging people an interest rate in the last quarter, 11.6%. Unbelievable. But with that also comes a really high, default rate of 4.6%. So that's really where, the difference between potential income and net income really, really change, because the cost of these loans is high, right? You have to add in all the different warehouse and deposit expenses, plus all of the default rates to really get a net potential interest. But then I want to talk about this number right here, total weighted averages, because this is super cool, right? Even back whenever SoFi started their business, they were a student loan company, but even back in Q2 of 2020, which was a year before we even went public, which is the earliest I could actually source some public numbers for us, okay? Which was, total averages. Even back then, student loans was still a smaller category than personal loans, just because the high interest rates that we were actually charging on our personal loans. It's super incredible. Okay, but now is really for this is the actual number that I want you guys to look at, okay? This is the total net potential interest. Big drum roll here, because it's super important, okay? This actually takes the potential interest, which is the number that I'm actually using to take the total number of interest that we could be making on our loans minus the sale of loans, okay? So the actual real health of the actual loans that we have, okay? Then you also have to add in all the costs of the loans, the default rates, all the warehouse and deposit expenses, everything along those lines, all with the, the proper weighted averages across the board. This is a total net potential interest. What we can see here is this. Total net potential interest has been going down over the last 2 years. Not by much. This isn't a free fall, but it is definitely going down. It's probably a reason why people are actually seeing a bigger hit to this stock. Default rates have been going up whenever we look at things like personal loans, as well as actually the cost of funding these loans lately, because although we're actually, we just became a bank charter and now we're actually starting to get slightly less, cost of loans, we are still giving out almost 2%. We are giving out 2% on our direct deposit clients, but then you also have to, given the amount that we're only giving 1% to the people that, don't do direct deposits. So it's actually lower than 2%, but still, these are big costs that are added to our actual amount that we can fund the loans for, right? These are new costs to us. So, the actual number has been going down. In fact, if we just actually look back here, the time that we actually went public was in Q1 of 2021, or in December of 2020. But still, the actual total, potential interest rate back then, net, was still way lower than we are today. So, that's another reason for potentially why, this is still a better time to invest, let alone all the different numbers that we were talking about before, whether it's through member growth. Since the time that we went public, 2.2 million all the way up to 4.3 million, this is not factoring in any of those things, right? This is just the actual health of our loaning business. But still, it is definitely a little bit of a shock to see that how much we've actually dropped over that course whenever it comes to the true health of our loans. But tell me what you guys think. Am I missing something in this number? I'm trying to track every single thing that I can actually find whenever it comes to damages to our loans, whether that's through FICO scores, and that could actually be a potential reason why we're seeing higher default rates, or interest rate hikes, or anything like this. I'm trying to track it all. So please let me know in the comments down below. I promise you guys, I read almost every single comment that you put down there. I try to get back to you all in a timely manner. And, hopefully you guys enjoyed the video. But aside from that, please give me a thumbs up and subscribe down below if you want to see more financial content. But that's all I got for you today. Bye now.